After several decades of economic breakthroughs, the science of investing was recognized in 1990. The Nobel Prize in Economic Sciences awarded to 3 investment research pioneers for their collective work known as modern portfolio theory. Harry Markowitz for research regarding portfolio construction in relation to risk and return, William Sharpe for his capital asset pricing model and the concept of beta, and Merton Miller for modern corporate finance theory and the theory of company valuation with respect to dividends. When Harry Markowitz was a doctoral student at the University of Chicago in the early 1950s, he concluded that investment diversification reduced risk. His groundbreaking paper, Portfolio Selection, was the foundation of modern portfolio theory and established him as a pioneer in the financial industry. He's commonly referred to as the father of modern portfolio theory. Markowitz's contribution showed assets should be evaluated not only for their individual characteristics, but also for their effect on a portfolio as a whole.
Welcome to IFA TV. I'm here today with my favorite guest. We've had a lot of different guests here at IFA TV, but Harry Markowitz is sort of the epitome of our guests. Harry is known as the father of modern portfolio theory, and he's quite a Renaissance man, interested in music and theater and all kinds of books. He's got a very interesting book collection that we've been talking about. He's also very interested in philosophy. And so, Harry, I wanted to ask you about sort of your early years, and what was it that sort of drove your interest to attending the University of Chicago and to studying economics?
Okay. Now, when I was in high school, I read science at a popular level, like the ABC of Relativity.
Wow.
But I read philosophers, the original works, like Aristotle and Plato. And my favorite philosopher still is David Hume, an inquiry into human understanding. And Hume said that despite the fact that I have released this pen hundreds of times and it always goes down, that is not proof positive that'll go down next time. Or to put it another way, just because Newton's universal law of gravity had been confirmed thousands and thousands of times, did not prove that eventually a better theory of gravity would come along.
Yeah.
And so I was very impressed by that. When I went, and in general, I was interested in what do we know and how do we know it?
Okay.
So when I went into first the University of Chicago, the survey courses where you get a bachelor degree, and then into economics, just because I had to choose something, I chose economics. I spent 5 minutes. I spent more time at lunchtime deciding I was going to get the lamb and not the chicken than I spent, choosing economics. Anyway, eventually I wandered into the economics of uncertainty, because that was close.
Very important.
And this eventually led to portfolio theory.
Sure. I love Yoda's quote about uncertainty. He said, hard to predict the future is. Yoda from Star Wars.
Yeah.
Well, so
I have a cutout of Yoda in one of my offices.
Yes.
The other office has Darth Vader cut out, a big
for sort of the dark side of investing. Right. Yes. We're working with the force, we like to think here.
Right.
Yes. The market
force is on our side.
The forces of the market, the wisdom of the crowd, the collective brain, right? All of those good terms. So the term modern portfolio theory, yes, be sure to diversify. Yes. The term modern portfolio theory, now, your work was published in 1952, which happened to be the year I was born. Speaking of Star Wars, is sort of my destiny to bring this to our viewers, since I was also born that year. But that's 60 years ago this year, and I'm just kind of curious why they still call it the modern portfolio theory.
Well, I never called it modern portfolio theory.
Okay.
I didn't even call it portfolio theory. I called it portfolio selection. But I think portfolio selection.
As here.
Portfolio selection.
Yep.
Right.
The 1959 book here.
The article was called Portfolio Selection. The book itself, while the spine says portfolio selection.
Yes.
We'll hold it up to the audience. There is an audience.
There's somebody out there.
Oh,
Yes.
hell yeah, there.
Hi, out there.
I forgot who had the red camera. It says portfolio selection in the subtitle, efficient diversification of investments.
Yes.
Okay, so I think Bar Rosenberg was the one who coined modern portfolio theory, MPT, and I think that's wonderful that they still call it modern portfolio theory, because despite the fact that you're 60 years old, obviously I must be older than 60 years old. I was 24 when I published the first,
Yes.
the 1952 article, roughly right today, roughly.
Yes. Yes.
60 years ago.
So if our viewers can do a little math, they can put those two together.
I'm 84.
He's 84.
I'll be 85 so I'm modern. I'm still modern.
He's still modern. Very good.
Thoroughly modern Markowitz.
That's a good one.
Okay. I was in the economics department of the University of Chicago.
Yep. Very famous place.
Very famous place. When I went into the University of Chicago, I had no idea that it would have eventually many, many Nobel laureates. It was before a Nobel Prize was given in economics when I went in, but I sure lucked out. Right. I was at the stage where I had to pick a dissertation topic.
Yes.
And I went to my advisor, Jacob Marshak, Jacob Marshak, and he was busy. So I sat in the anteroom, outside, and the guy next to me, another guy was waiting for him, was a broker. And so we started chatting, why were we here? Right. And he suggested that I, do a dissertation on the stock market using econometric techniques that I've been taught. And one of my biographers said that is the best advice a broker has ever given anybody. So when I got into Marshak, I went in before the other guy. I said, the guy out there thinks I ought to do a dissertation on the stock market. Yeah. So Marshak said, I was at the Coles Commission. Yes. Later it moved.
Alfred Coles?
Alfred had endowed it. Alfred Cole III, I believe.
I think it is the third, yes.
And he not only endowed it, but he had done some of the, I don't know if you know this, but for example, Coles Commission Monograph 3 is by Coles himself.
Yes.
And he was one of the first, maybe the first, who said, let us look at the predictions, which, as you know, forecasters can't forecast. So he was in he was in this field before I was.
Out in Colorado Springs.
Out in Colorado Springs.
Yes,
I don't remember it personally, but
tuberculosis, and that's where they went there.
I didn't know that.
Get better. And,
I learned all sorts of things on these interviews. Anyway, so I said, Alfred Coles had hoped that people would do econometric research on the stock market.
Right.
But I, Marshak, don't know the literature, so he sent me to Professor Ketchum over in the business school. I've recently learned that he was actually the dean of the business school at that time.
Right.
Professor Ketchum gave me a reading list. The reading list include, of course, Graham and Dodd and Wiesenberger investment companies in their portfolios.
Yeah, that's this one.
We just happen to have.
Just happen to have Wiesenberger here.
As it turns out.
Yeah. Arthur.
Okay.
That's 59.
That's 19.
That's after.
No, but that's been going since the 30s or something. Sure. So I was sitting in the library sometime in 1950.
Yes.
It was an afternoon, just given my work habits. And I had read Wiesenberger, I'd read Graham and Dodd, and I was reading, do you have a copy of John Burr Williams' Theory of Investment Value?
I do have one in there somewhere, but I'll have to see if I can dig it up. Maybe while you're talking, I might go take a look here, but go ahead. I know the book.
You're going to just let me here sit in the wind, dangle in the wind, and you're going to go look in your book. Well, just trust me. That's his way. Yeah, it's back there.
Well, I thought you might wanted me to grab it. But
no. I know what's in there.
Okay, yes.
So Williams at one point says the value of a stock, or the price of a stock, the value of the stock should be the present value of its future dividends. So, dividends are uncertain. I'm thinking to myself, he must mean the expected value. And later in the book, he does say when things are uncertain, use the mean value, the expected value. the average value.
Yes.
Okay, so if you're only interested in the expected value of something, of a security, you must be only interested in the expected value of a portfolio. And the way you maximize the expected value of a portfolio is you put all your money in whatever stock has the highest expected value. You put all your eggs in one basket.
Right.
Well, I've been just reading Wiesenberger, and I know people paid investment companies to diversify their portfolios.
Right.
Okay, so why do they diversify? Because they're interested in risk and return. Return is expected return. Risk, well, everybody uses standard deviation, so I just use standard deviation. So
that gets us to Upinski.
Well,
almost,
you're
just a little ahead of that. I just want to make sure you knew that was there.
Okay, I know now.
Okay, good.
Oh, thank you again for many years ago getting me my own copy of Uspensky.
Yes. Well, let's get to that part of that story. Yeah.
So I think of securities, returns on securities like random variables.
Right.
And of course, a portfolio is the return on a portfolio is a weighted sum on the returns of the individual securities, weighted by how much you invest in each security. And I know offhand what the expected value of a weighted sum is, but I don't remember what the variance of a weighted sum is. And so it just so happened that at lunchtime, we got out page 174, and you see, this doesn't quite look like what I had, because it's got, the variance of the first security, well, these aren't securities, variance of the second security, these are random variables.
Random variables, sure.
Plus twice the correlation between the first and second times the standard deviation of the first times the second, the second, which we've already learned as the covariance. And so I see this formula, and that's my moment of Uspensky. I get,
I was just looking at the title of this, yes.
Introduction to the Mathematical Probability.
Yeah.
In other words, go back, I left a little step out. You've gotten me all flustered, you know.
I'm sorry.
Yeah, that's okay, Mark. I forgive you. Anyway.
Okay.
So I remember I'm at the stage where I know the expected value of a weighted sum. I don't know what the variance of a weighted sum is. I get Uspensky Introduction to Mathematical Probability over through the shelf. I start, this is in the library, I start browsing around. I get somehow to page 174, and then bang, it hits me. The volatility, the variance of a portfolio depends not only on the volatilities of each of the securities that's in it, but it also depends on their covariances or correlations.
Right.
So that's my moment of truth, my epiphany.
Now, when that thought hit you, did you have any idea what its impact might be, 60 years later?
I had,
62 years.
This train of thought that said, people might actually use this. People now, with institutions and so on, invest billions and billions of dollars. Maybe by 2012, they will be investing trillions of dollars using this. That thought never went through my head. What I thought was, I'm going to get my PhD.
Never expected. Well, they took quite a while to get to that Nobel Prize.
Well, first place, they didn't give a Nobel Prize in economics till what, about 1950?
69, I think.
69, is that?
I think it was 69. Samuelson was the first one.
No, the first
was U.S.
No,
right.
Samuelson was not the first one. There was a
first U.S.
There was a Swedish or Norwegian or something.
You're right.
Halvamo.
Yeah, I'm not sure how many years before. Maybe 5.
Well, no. Yeah, but Samuelson was the second or third.
Okay.
Economist.
Yeah,
first,
so maybe 3 or 4.
Maybe 3 or 4. Yeah. So they hadn't started, and then after they started giving out prizes, they had to give it to real economists, the ones that did micro and macro and right. Did you know that economics is the only discipline where 2 people can get Nobel Prizes for having diametrically opposite views? My good friend Paul Samuelson and one of my professors, Milton Friedman, being cases in point. Right. Anyway.
Right.
So first they had to give it around to, they had to give them to Samuelson and those kinds of guys.
Right.
And then Arrow got one, and all my friends at the Coles Commission got ones. And then they ran out of people at Coles Commission, so they had to give it to me. No, that's not. No, they finally decided that we have been, financial economists had been quoted enough and are enough in the economics literature that they should get their prize.
Excellent, excellent. Now, you'd also told me that Merton Miller's prize didn't quite fit in with yours and Bill Sharp's.
Well, Bill and I...
Remind me of that story, yeah.
Well, let's see. I got it for portfolio theory.
Correct.
Which is...
in 1990, by the way. We didn't maybe say that.
1990.
Yeah.
I got it for portfolio theory, which has to do with, it's a normative, how one ought to, how one single investor, might be an institutional investor,
right,
but how one single investor ought to invest their money if they don't like risk and they do like return. Bill Sharp...
Like most of us.
Yes, on the assumption that, well, there are people that go out and gamble.
That's right. Okay, and then Bill Sharp.
Then Bill Sharp got his for the capital asset pricing model,
yep,
which says if everybody was if everybody invested like Markowitz 1952 or 1959, and if certain other assumptions were made, everybody has the same beliefs and so on and so forth. If that were true, what would the capital markets be like? Okay. So this is a capital asset pricing model. Right. So that's the fact that we should share sort of makes sense. Miller got it for the famous Modigliani-Miller theorem. Now, why is Miller muscling in a third of Bill Sharp and my prize when he did his work on the Miller-Modigliani theorem? Right. That's because Modigliani already got his prize, not for the Modigliani-Miller theorem, but for miscellaneous great works in economics. Okay. In macroeconomics, right, econometrics.
Okay, I want to go back just a little bit. We talked about your sort of epiphany in the Library of the University of Chicago, and that led to your paper called Portfolio Selection, which was published in March of 1952. It says here, while you're at the Rand Corporation.
Yes, yes, sir. Yes, sir.
And I love the story about when you went to present this as part of your dissertation and how it was characterized. And
okay,
so why don't you share that story with us? Because it's really fun.
I had left University of Chicago with everything finished except the dissertation.
Yes.
I went to the Rand Corporation. I left Chicago the year it was 19 below zero in February, and I've never been back again.
And what was it in Santa Monica at the Rand Corporation?
Oh, 70. We would
all the time.
My wife, my 2.5-year-old and my half-year-old would watch on a little television set, this big,
right,
the weather report. Yes. And they'd say, and in California, and in Los Angeles, it's 70 degrees, and we'd cheer.
Okay, anyway, so you're back to Chicago.
Okay, so I'm on a trip from Washington, from the Rand Corporation office in Washington, D.C., on the way back to the Rand Corporation in Santa Monica, California, where it never snows. Right. I stop off at Midway Airport. This is before
Chicago. Yeah.
This is before O'Hare.
Yep.
And as I'm to defend my dissertation, and as I am landing, I think to myself, I know this field cold. My dissertation was about portfolio theory. Yes. I know this field cold. Not even Milton Friedman will give me a hard time.
Famous last words.
Famous last words. So I get into, next day, defense. About 5 minutes into it, Friedman says, Harry, I've read the dissertation, and I can't find any bugs in it. but this is not a dissertation in economics, and we can't give you a PhD in economics for a dissertation in economics. Yeah. And for the next hour and a half, most of that hour and a half was spent with Milton Friedman telling me I wasn't going to get a PhD degree in economics for a dissertation with not economics. At one point, he says, Harry, you have a problem. It's not economics. It's not mathematics. It's not business administration. And my dear, sweet head of my committee, Yasha Marshak, shakes his head and says, it's not literature. and that keeps up for an hour and a half. Then they sent me out in the hall, and about 5 minutes later, Marshak comes out and says, congratulations, Dr. Markowitz. About 10 or 15 years later, I didn't know, I wasn't in regular contact with Friedman. I mean, he was in Chicago or Stanford, and I was in at Santa Monica. Right. But we were on some boondoggle together of some sort, you know, some investor, had a plan that never went through. But I had occasion to ask him, you know, I reminded him of the incident. There was no big deal in his life. I said, Milton, were you serious? He says, you know we never flunk anybody at that stage. So well, he was just...
Harry, we really appreciate you sharing these early days with us. Harry, when you published your paper and your book actually in 1959, there was a relatively long period, I guess, what did we have, 30-some years before the Nobel Prize was issued. Now, I'm sure there was a lot of other academic research that was covered over that period. Let's talk about some of that research, and maybe you can try to characterize at least some of the major themes over those years.
Well, my article was published in 1952.
Yeah.
Year you were born.
Yes.
Very little happened in terms of general recognition between 1952 and 1964, which I will tell you what was unique about 1964. But I'll just quote one article. There was by Weston and Beranek. Weston is Fred Weston, who was Bill Sharp's professor. I'll tell you about that later. And he was also the publisher of the Journal of Finance, which where this thing appears. So I knew him from as the editor. You know, I had submitted it to the Journal of Finance. This my 1952 article. I later learned that the way this 1956 or whatever it was, 55, 56, Weston and Beranek article happened was Beranek was a student of Fred Weston. And he had a little bit more math than the rest of the class.
Yes.
So Fred asked him to read my article and give a class report on it.
Okay.
And so they wrote an article of their own saying what Harry Markowitz said. I thought I had been perfectly clear, but they had a Harry Markowitz. Many, many, many years later, I was giving I gave a talk in Atlanta, Georgia.
Okay.
And somebody said, would you like to meet, I can't remember Berenek's first name.
All right.
Whatever. Bill Beranek, whatever it is. Beranek.
It's amazing you come up with what you come up with, by the way. Your memory is amazing.
For some things.
Even
jokes
60,
I can read.
I'm starting to lose some of these names.
I don't know.
But go ahead.
So I met Beranek for the first time, you know, and he told me how this article came to be. He was teaching at some place in Georgia, not in Atlanta, but an hour's ride from Atlanta, roughly.
Sure.
And he said that he thought my article, my 1952 article, was very interesting, and he proposed that he write on that subject for his dissertation, but the head of his dissertation committee said, don't write on that subject, write on something practical instead. Anyway, so now in 1950, the best of our, sometime in 1950.
Yes.
No. In 1960. I did my work in 50 and published in 52.
Yeah.
In the best of our, Bill Sharp and my being able to piece things together, sometime in 1960, a young man, I was working at the Rand Corporation. I had already published my 59 book. I was working on some other kind of topic that I was at the Rand. A young man presented himself at the my door, said, "My name is Bill Sharp. I too work at the Rand Corporation, and I'm also trying to get a PhD at
UCLA.
At UCLA."
Yeah.
And you've heard this before.
No,
anyway,
no,
that's fine. That's fine.
Yeah.
At UCLA, and my professor Fred Weston suggested that I, Bill Sharp, come and ask Harry Markowitz for a dissertation topic.
Yeah.
So one of the things that is very important in this book, central, right from Uspensky onward, is the notion of correlation or covariance.
Yes.
And so there is one expected return for each security, one standard deviation or variance for each security, and one and there's one covariance for each pair of securities.
Yeah.
So if you had as few as, let's say, just 100 securities, you would have 100 variances, 100 expected returns, and 100 times 100, 10,000, except half of them look like the other half, so 5,000 covariances. You've got too many covariances. And the book on page 94 to 100.
Okay.
I don't know too many chapters. I don't remember every page. I remember.
I don't believe that.
I remember 121 and what chapter 3 has in it. But is what I call models of covariance.
Okay.
Bill Sharp and I sat at my office at the Rand Corporation, and I told him about the problem of too many covariances.
Okay.
And I suggested that he try out the one-factor model, see how well it worked. So he, that was 1960, Sharp, 1963, a simplified model of portfolio selection concludes that, given his data set, that the one-factor model was as complex as you needed. So not only did he say the one-factor model was as complex as you needed, but he also figured out a fast way of computing when you have the one-factor model, which can also be used for a three-factor model, like the Feynman French three-factor model, which DFA uses, can be used for very fast. You could have thousands of securities nowadays, and on your PC, those days computers were slower.
Yes.
Okay, so he not only found empirically, given his sample, that the one-factor model was as complex a model as you needed, but he also figured out a fast algorithm, and he published a Fortran code. He made available to everybody a Fortran code.
How interesting.
For
this.
But that is not the event that brought the economists into the field. His next year, himself, no advice from me, maybe some skepticism even on my part, but himself did the capital asset pricing model.
Okay.
So between one-factor model, his Fortran code, the capital asset pricing model, then the field started to bloom.
Wow. Okay. And so what are some other discoveries that came along after that?
Well, there's
how about Fama's random walk theory?
Wait a minute. Well, there's
efficient markets.
Bachelet's.
Bachelet.
I think that
was way back.
1900 efficient market. And there's Kuttner's the random character of the stock market
prices
and people the market. Yeah, but the big event, was Brinson. Gary Brinson.
An asset.
Brinson Biebauer,
Biebauer, and I can't remember the other one, but yes.
The one came second. The Biebauer, somebody in
Brinson?
No, Brinson, somebody in Biebauer.
We'll look it up.
Yeah,
we'll give it as
that
a subtitle.
guy is going to get so mad at us.
Yes.
Brinson.
I was just trying to think if I might have it here somewhere. We don't. But anyway, let's go to Brinson's paper. They generally call it Brinson's paper, but
I teach at UCSD.
Yes.
1 day a week.
Yes, University of San Diego.
Oh yeah,
yes.
UCSD. Everybody knows
That's okay.
UCSD. Yeah.
Yeah,
I mean UCLA, UCSD. Yes,
Yeah.
UCLA.
We have a whole world. It's a world wide web today, right? So we got a whole world watching this.
Hello in Tokyo.
Hello in Tokyo. Finland. We're big in Finland, by the way. I don't know why.
Say sayonara, but
and,
I don't know
and Norway. They love us over there.
Okay, that's wonderful.
And where? In Turkey.
Oh,
they tell us off stage here that we're big in Turkey too.
Istanbul is one of the prettiest places, but we digress again.
We digress, but that's okay. Go ahead. Okay. So let's see. We were
Gary Brinson.
Gary Brinson
and colleagues.
Yes.
Now they came out with a paper saying that 94% or something, 89%, 96.3%.
Large percentage
of performance is due to
asset allocation.
Asset
allocation.
As distinguished from stock selection.
Or now, market timing. Yes.
Or market timing. Yes, right. Ibbotson and Kaplan, Roger Ibbotson, and Paul Kaplan say, no, it is not 94%, it's 86.2%.
Yes,
and then Brinson and two different colleagues say, no, it's not 90. Now, the important thing is not whether it's 65 or 87 or 99. The important thing is that thousands of financial advisors who are not Warren Buffett and cannot pick stocks are able to give sound advice to their clients on this top-down use. You do your mean variance analysis, your modern portfolio theory at the asset class level, and then you get, hey, index funds. Yep. Did you know there are people around called index fund advisors?
No, I had no idea.
That's wonderful.
What a great name. We'll have to see if we can get that. Yeah, in fact, I think I've read Bill Sharp called I think it's the grandfather of the index fund.
Oh, Bill Sharp is the,
that was Business Week or somewhere I read that. Yeah. So one of this is sort of tied together, I guess, is that after the legal people who wanted to help prescribe what was prudent investing for trustees, after they looked at this important published research and the Nobel Prizes that were awarded for that research, they decided to restate the Prudent Investor Act, and they included a number of points in there that I think really tie to your research. And I've got them here in this paper. I'll just take a look here. It says that sound diversification is fundamental to risk management and is therefore ordinarily required of trustees. So let's just talk about that idea of sound diversification. And if we Google diversification, we got about 27 million results, and the whole first page was just about investing. And I'm sure half of those probably cite you, if not all of them, cite your original work. And so I don't know if we've used that term, maybe we did a little bit, but let's talk about that wonderful term, diversification, and how it's a risk reducer or allows you to control risk better.
Well, let me tell you a little story about diversification.
Good.
This has to do with the legal profession.
Okay.
My son is a lawyer. So David, he's a lawyer, what does he know about portfolio theory? He says, Dad, I have a story to tell you. A client of mine lost $90 million out of $100 million of his client's money. I said, that's very interesting. How do you do that? Well, this is Indian reservation money, gambling money. So the Indians came, the chiefs came and said, the other tribe is getting 18% on their money. We want 18% on our money. And he explained that's very risky and so on.
Right.
And they said, no, we want, the other tribe is getting 18% on their money. We want 18% on our money. Okay. So he put them into as diversified as he could set of securities, paper, that was paying 18% on the money, on, per dollar. This was all luxury, travel-related luxury things like fancy golf courses and resorts and so on.
Right.
Okay, and then 9/11 happened.
Wow.
And nobody traveled.
Anymore.
Nobody traveled.
Oh.
And so, but anyway, the Indian chiefs brought his client into arbitration.
Yes.
And each of their expert witnesses got on the stand and said, Harry Markowitz would have diversified the portfolio. And all the three arbitrators look over to David, who they know is
Markowitz.
They know who his father is, and David is just waiting his turn. He's sort of looks like me, except he's 6'4", good looking. Anyway, 20 some years old, younger than I am. Anyway, so when David's expert witness gets on the stand, he says, your client, David, Mr. Markowitz, told them that this was risky. He tried to diversify as much as he would, subject to the wishes of the client.
Sure.
And they stuck their neck out when they got it chopped off. It's, you fly too close to the sun, your wax wings melt, and you drop into the drink. So I tell my students at UCSD this. I say, a risk factor which had never happened before and may never happen again happened because somebody had leveraged too much. So the point is that it's not sufficient to have, to go back to your question about diversification.
Yeah.
One of the things that the article says and the book say, diversification doesn't mean that you have a lot of securities.
They have to be.
They have to be, they have to
covariant.
They have to be. They have to, reflect
low,
the covariance. They have to
right.
be as low as you can
correlation.
find.
So
as low as you can find.
Some people often say one zigs while the other zags,
Yeah,
right?
right.
So they're
but
going like
now,
this. Yes.
There's something in the book, one of my favorite chapters of the book, I can't remember what page it's on,
That's all right.
is chapter 5.
Yeah.
And I don't remember, it's called Investment in Large Numbers of Securities, but I now call it the law of the average covariance.
Okay.
The law of the average covariance. And it says that the variance of the portfolio doesn't approach zero as you diversify more and more. It approaches the average covariance. Okay. If things are uncorrelated, then their covariances are zero and the variance approaches it. See, the problem with, let's go back to our earlier segment.
Yeah.
Let's remember John Burr Williams said that you should put it into the mean.
Yes, the highest returning.
Well, just put it.
But you expect the highest return.
The value he said the value of the portfolio should be the present value, the value of a security should be the present value of its future dividends.
Yes.
And I said he must mean, expected value. So later in the book, he says, when there's uncertainty, you should use the mean value.
Oh.
You get the right thing on average. And then he gives an example of a bond and selling at a discount. But he says you will get the right thing, on the average. And with sufficient diversification, all your risk will be reduced to zero. I mean, not quoting, but essentially he said, the variance of the portfolio will approach zero as you diversify more and more.
Right.
Now he was assuming, he was using something called the law of large numbers, which assumes independence.
Yes.
This thing which this law of large numbers does not apply if you have correlated risks.
Right.
And as some other interviewers say, or I said in another interview, how anybody could have just, you know, this he was published in 37 or something, how somebody can be 8 years back from 1929 and 30 and 31 and 32 at 33 and assume that risks are uncorrelated. Right. Lord knows. But he didn't have the apparatus.
Yes.
He hadn't got, he didn't pick off the library shelf a copy of Uspensky and find these. So it is not true that the variance of the portfolio approaches zero. It approaches the average covariance, and then it gets technical to
you get down to the systematic risk, right? You get rid of the unsystematic risk, but you're still stuck with market risk.
Yeah, it turns out, for example,
which is plenty.
Let me give you a, yeah, that's what you put.
Plenty of risk, as they say,
Let me give you a numerical example.
Okay.
So if it were true that all securities had the same standard deviation, same volatility, you know, just for the example.
Yeah, just for example.
And all of them had a correlation of 0.25,
okay,
which is a modest annual correlation. Then the variance of the portfolio would approach 0.25 times the variance of the individual stock. But we're not interested in variance. We're interested in standard deviation. That's the square root.
Yes.
So volatility, well, the volatility, you know, let's see, the square root of 0.25 is 0.5. Remember that. The square root of 0.25 is 0.5.
Yeah.
The standard deviation, the volatility of the portfolio would approach 0.5 times the standard deviation of the security. So the infinitely diversified portfolio would have a volatility 50% as great as if you put all your money in one stock.
Yep. That's what we often say. We say a stock may have a standard deviation of 30, but the market's about 15.
Right. That's, there you go.
Yeah.
So how do you...
After the crash.
So if more and more and more diversification among stocks is not going to reduce your... this is a rhetorical question. You know the answer. You've made a living on this answer. How do you reduce the volatility of your portfolio? Obviously, you got to have some fixed income stuff.
Yeah. Once we get down to the equities, then we have to have fixed income.
So people say, look, my broker told me I should go into emerging markets and leverage this and that, and it would diversify my portfolio. The crash happened. All the correlations went to one.
Right.
Well, that's the law of the average covariance. What's new?
Yes, exactly.
I wrote an article whose name is, well, no, it started out as, when I submitted it, the journal, the Professional Investor or Investment Professional, it's the journal of the New York Society of Security Analysts, asked me to contribute a paper. So I contributed the paper. They changed almost nothing except the title.
Oh.
The title I submitted was, during crises, all correlations approach one, of course. And they had instead portfolio theory under pressure. And it showed this guy at a laptop, but he must have been underwater because he was being circled by sharks. But other than that, they left everything as is.
Oh, well, that's a lot of fun, Harry. I really enjoyed that. So, Harry, let's talk about what I like to call the Great Panic of 2008 and 9, where we experienced what some people like to call a black swan. And then there were a number of articles written about the death of the modern portfolio theory. What's your response to those reactions?
Well, let's decide you and me whether 2008 was a black swan. Now, what's a black swan?
What is a black swan?
Okay. In this context, it means an outlier.
An outlier.
Some observation, some return, which is way beyond what you would expect if things were normally distributed or whatever. Beyond
maybe 3 standard deviations, or maybe
four or 5 standard.
I think Nassim had a 24 standard deviation daily return that he referred to in 1987,
October 1987.
Yeah.
I have on my corkboard.
Corkboard in your office. Lots of great things.
I have a plot that somebody at Morgan Stanley Asset probably a doctor, Ms. Goldberg supplied, showing daily returns on the S&P 500. And October 19th, 1987 was an outlier.
Yes.
But we're not in the daily trading business.
Yeah.
What about the year 1987? That was you remember?
Yeah.
Didn't go up, didn't go down. If you had,
non-event.
If you do, like I recommend, look at your portfolio once a year when you do your income taxes.
That's good.
Then 1987. Now you recommend that you should look only on February 29th.
Yeah, I stretched that out a little bit.
Yeah,
February 29th.
4 years.
Well, every 4 years, you're pretty good shape. There aren't too many.
I figure you may get a little curious. Okay, now 2008. If you use, I recommend in estimating standard deviations, volatility, annual volatility, that you use the information back to 1926 when the Ibbotson series started. And some people say, oh, just use post-war, it's more applicable. No, I've always said back to 26 because I've said essentially every year nature puts her hand into a basket labeled S&P 500 and draws out a return.
Yeah.
And somewhere in that basket is another 1930, 29, there was only a part, 30, 31, 32.
Yes.
By 33, it's getting up. So I'm not sure that the true probability on a forward-looking basis is the same as the historical frequency, but I'll feel more comfortable doing analyses, including 1930 and the history than not.
Yeah.
So going back to 1926 and computing your standard deviation that way, then 2008 was not a 3 standard deviation or a 4 standard deviation. It was just about a 2.5 standard deviation.
Because the standard deviation is 20 when you go back that far, and the mean is around 10.
Right, and 10
so
minus
10 minus
2 times
60.
20, and so on.
Yes.
It was a 38% loss, and so it's about...
So 10 minus 40, we're minus 30, somewhere in there.
Yeah, okay, so it's a little, but just short of a 2.5 standard deviation move. Now, if it were a normal distribution, I don't say it is exactly normal, but if it were a normal distribution, bell-shaped distribution, then 2.5%. The two tails have 5. The two standard deviations and more. I mean, not precisely 2.5 standard, but 2 standard deviations and more on the bad side has 2.5% of the distribution. The two tails have 5%.
Yep.
The bad tail has 2.5%.
Yes.
That's a 1 year in 40. So we're celebrating my 60th year in the business. I've got to expect a 1 year in 40 event once in a while. Yep. So it was not a black swan.
Yes.
Okay. Now people say all the correlations went to 1. Now remember the law of the average covariance. The volatility of the portfolio does not go to 0, it goes to the average covariance.
Yes.
There was still a lot of volatility. In our little numerical example, there was still a volatility. Right. Now it is true that most of the asset classes moved in the same direction, but not by the same amount. We discussed Bill Sharp's one-factor model. The one-factor model says the amount that you move should be a combination of 2 things. One, your beta times how much the market moves or how much the underlying factor moves, plus something called the idiosyncratic term, the extra.
Yes.
That's the hardest part of our business, being able to say idiosyncratic.
That's a tough one.
You can tell the experts from that.
Right.
Okay.
I can't even say the Modigliani either. That's another one.
Modigliani?
There you go. I keep getting that one mixed up.
Oh, wow.
Maybe I better spell it out. That always helps.
Oh, yeah. Write it out. Okay. So the large cap stocks, the S&P 500, went down 38%. emerging markets, the way they measure betas, the large cap stocks have beta of 1.00000.
That's right.
That's just because that's the way they measure it.
That's it.
Okay. Emerging market has a larger beta, and it went down by more than 50%.
Yep.
Corporate bonds have a much smaller beta. They went down a few percent, and government bonds actually went up.
Went up. I think
Okay,
government
so
bond fund
everybody
was up
moved in the
4%.
same direction,
Yep.
but not by the same amount.
Yes.
And
the bonds were positive.
And the government bonds were positive.
Yes.
So if you were high on the risk-return trade-off, what they call the efficient frontier,
Yes.
if you were high, you probably had a high beta. Well, you'd certainly have a high beta portfolio, and you would suffer. But on the average, over the long run, you would do better.
Sure.
If you were lower, you suffered less.
Yeah.
If you were all in cash, you didn't suffer. If you were in Treasury, T-bills, you didn't suffer. But on the average, over the long, you pays your money, you take your choice.
You take your choices. Yes. Now, if you were in one of those high beta portfolios,
right.
there's only one thing I can think of that might keep you in there, and that's if you tied yourself to the mast.
Well, some people, if they have a long time to go, see, one of the things, you shouldn't go up the frontier
Yes.
beyond the point which has the highest geometric mean. Now, I know that's technical,
That's right.
but that's what you get in the long run. The arithmetic mean, which is higher,
Yes.
it's very confusing, but that's not what you get in the long run.
That's right.
So if you...
Because of that volatility,
Right,
correct?
well,
Yes.
yeah, that's right.
And that's why it's lower.
Right.
Go ahead.
So if you're above the portfolio with the maximum geometric mean, well, you shouldn't have been there anyway. That's not right. If you were up close to the portfolio with the maximum long run return, and now you see what a standard deviation feels like in real time,
Right.
you may want to come down the frontier.
So, I want to talk about a little known paper of yours, because we were talking a little bit about behavioral finance there.
I'm glad you...
Yeah, and you wrote actually a second paper in 1952 about the utility function, and we're going to announce to the world that you should be the grandfather of behavioral finance.
Well, part of the world already knows that.
Part of it. Okay, well, let's announce it to the rest of them.
Well, let me tell you on what, let's see. So I am generally known as the father of portfolio theory.
Correct.
No dispute. Whether you like portfolio theory or don't,
not.
whether you think there are black swans or not, either you credit me or you blame me.
All right.
I'm the father of modern portfolio theory.
Yes. Now, behavioral finance has been more popular lately. I'd say in the last 10 years, we're hearing more and more about it. So tell us about your
you have to distinguish between rules, which are put forth as advice, normative,
Yes.
and relationships, which are put forward as hypotheses about the world, the way the world works.
Right.
This book nowhere says that this is the way that real investors do mean variance.
Okay.
This article, I'll hold the product up, says it proposes the mean variance rule, as both a normative rule and a hypothesis.
Okay.
So that was 1952.
Yes.
By 1959, no mention of mean variance as a hypothesis.
Okay.
It's a normative rule.
Okay.
Now, it isn't that I forgot, that there's a distinction.
Right.
It just, at 1959, I was not ready to declare either way, whether people work this way or not this way. Actually, if you go back to the back of the book, the fundamental assumptions of Markowitz 1959 are in the back of the book, not the front of the book.
Okay.
Now, why did I put the fundamental assumptions of the book in the back of the book, not the front of the book?
So I have no idea. Please tell us.
Because if I had started the book with an axiomatic treatment of the theory of rational decision-making under uncertainty, nobody would have read it.
Yes. Yeah.
Oh,
you would have lost a lot of them.
Right. So
are the utility function issues covered in this book?
Yeah. This is my
my selected works. Yes.
This is my selected.
A shameless promotion. Unfortunately, it's very expensive, but anyway, it's worth every penny, I'm sure.
Right. That's right.
Because it's really the only collection of all your work.
Of all the work I want to.
Yeah.
All the work that's to print that I would care to still. It's
Anyway,
called selected works.
Yeah. So, but that covers some of the utility issues, right?
This
utility
book, this book, called Harry Markowitz Selected Works. Incidentally, it says Volume 1.
I saw that.
It's World Scientific Nobel Laureate Series, Volume 1.
Oh.
Bill Sharp's book is Volume 2. And if they get Fama or French, Nobel Laureates, it has to be. Okay.
Not yet.
Not yet.
Not yet for Fama.
Okay. So
maybe someday.
Well, if he keeps playing, you got to stay healthy, because once you're dead, you can't get a Nobel Laureate.
Yeah, that's true. And he's been staying pretty healthy. He's out there playing that tennis.
Unfortunately, Fisher Black died of cancer.
Yes.
Everybody knew that Black Scholes would get the prize. So Scholes and Bob Merton got the Black Scholes Prize.
Right.
Okay. But 1950. This is chronological.
Yes.
There's one chapter whose title is 1952.
Okay.
And it has 2 articles in it, which I elsewhere refer to as Markowitz 1952A and 1952B. Okay. And Markowitz 1952A is portfolio selection. 1952B is it's called Utility of Wealth. Hearst Sheffrin has a 3-volume set handbook on behavioral finance. I think it's just called Handbook on Behavioral Finance. Volume 3 is historical documents. Like Kahneman and Tversky is one of the historical documents. But the very first historical document in Volume 3 of Behavioral Finance is,
ta-da, drum roll please,
is Markowitz's Utility of Wealth. And Sheffrin, in the introduction, I quote, I'm not going to get this out like I did at lunchtime and read the whole thing to you.
Please.
No, we don't have that time. Says this is truly a behavioral thing, and so on.
I want to talk about that very unique moment that very few people get to hear, and that is the phone call from Sweden that lets you know that you have won a Nobel Prize. So, Harry, why don't you tell us about that call and maybe the subsequent trip to Sweden and the whole event, the whole story of getting.
Since this is the last few minutes of I'll take the liberty of at least smelling and sipping this cognac you so nicely provided.
Okay, very good. And toast that wonderful event, huh?
We were on leave. I was on a sabbatical.
Okay.
From Baruch College.
Yes.
I was at Tokyo University.
Oh, yeah. So
I was in Tokyo.
You were in Tokyo, okay.
Tokyo University, University of Tokyo, teaching a course on portfolio theory in the math department.
Oh.
They don't have a business school. It was in the math department. It was sponsored by the Life Insurance Association of Japan.
Okay.
Okay. Nobody knew quite where I was. We had just moved, and they couldn't find me. And they couldn't wait forever to announce it, so they announced it. So the phone call that one usually gets from Nobel, I didn't get.
You didn't get? Wow.
I got a phone call from the head of the math department at Tokyo University, saying, you have just won the Nobel Prize, and this guy named, this particular name and number at public television, the Japan public television, whatever it's called,
Yeah.
would like to interview you, call him. Now, the head of the math department at Tokyo University, I can't remember his name, was not a kidder. There's no way he would play a practical joke, but we still wanted to hear it ourselves.
Right.
So there is an armed forces radio station out of Okinawa, in English, of course.
Yes.
And at the top of the hour, they do the news.
Okay.
And top of the news was, Markowitz, Sharp, and Miller have won the Nobel Prize in Economics.
Wow.
Later asked me, was I surprised? But that's another story.
Okay.
Okay. I may need another. Need another slip of my whiskey.
Okay.
My cognac.
Your cognac. Yes.
My cognac. Okay. So we called this gentleman.
Yeah.
And he said, I'd like to interview you. And I said, well, I have some time between 3 p.m. and 4 p.m. tomorrow. He said, no, I want to be on the 9 o'clock news. So I said, come on out. And we did a quick interview where they rushed it to the studio.
Yeah.
I could see myself, on the news, and then he did a more leisurely interview that night. Okay.
Wow.
So actually, it was a surprise to me. Let me tell you why it was a surprise to me.
Okay.
Several years before, James Tobin got the Nobel Prize.
Right.
And the newspapers and radio announced that he got it for portfolio theory. A couple of weeks afterwards, when he came back from Japan, he called me and said, I didn't get it specifically for portfolio theory. I got it for miscellaneous great works in macroeconomics, just like Modigliani had gotten his prize before Miller got his. So I had decided, but from that point on, essentially, I had decided that they had given the prize in portfolio theory, and I did not get it. And that did not completely surprise me or floor me, because they had given a prize in linear programming 2 or 3 years before that, and George Danzig didn't get it, and that was a scandal among all of us in that profession.
Wow.
So the day it was announced that Tobin got the prize for portfolio theory,
yes,
I was at a meeting in Silver Springs, Maryland, and I had given my paper the day before.
Right.
And when it was announced, I said to Barbara, I don't feel like showing up at the meeting. So we got into our car. It was a rented car. We drove through. Maryland has horses and these white fences like Kentucky.
Yes, I'm aware.
I didn't know that. And so we drove past these white fences with the horses, tranquil. Then we come to a little town. It has a big Woolworths, probably is the Woolworths for you remember Woolworths? It's been a while. It's like Sears, but it's not. It's dead. Like,
right.
Yeah, they come and go. That's why you don't try to stock pick. Anyway,
that's a good one.
So we go into this Woolworths. We get 2 great big I got a big ice cream cone, and my wife got a little ice cream cone.
Yeah.
And after I got through with my big ice cream cone, I said, I'm ready to rejoin the world. Oh. And from that point on, I never considered, Nobel Prize. Barbara said she always paid attention. She always paid. She knew that she said she was a day off because we had changed, she knew what day it was announced on, maybe October 10, October 11, whatever it is.
Yeah, I think it's 10 or 11,
yeah. But we had crossed the date line.
Oh, I see.
And her October 10 was not,
the one in
Sweden
Japan.
was not
Or
the
Sweden.
Swedish
Yes.
October 10.
Yes.
And so So she was surprised.
Well, you were also the recipient of the von Neumann Prize.
Von Neumann.
Von Neumann. Why don't you just tell us about that?
Okay.
Just a couple minutes.
This was a prize. When you come to my office and walk around, everybody's invited, but you have to call up in advance so that so that
we don't want
we schedule.
Well,
I can only do so many lunches but I show people around and I take them. You say, this is the medallion. This is the. I have under. It's not the real one. It's not. Right. It's a brass. But the real one is gold and it's in a vault. I assume it's in a vault. I haven't seen it for years.
Yes.
That's right. But here's the brass one.
Yeah.
And it's in a plexi. It's under glass, not glass.
Right.
And then I say, here's one that's 3 times as good, and it isn't under glass. So I say, of course, it didn't pay any money, or maybe $1,000 or something like that.
Yes.
But it happened the year before.
Right.
It was given by Tim Zorsa, that's the Institute of Management Science and the Operations Research Society of America. They've since merged.
Yeah.
It's the von Neumann Prize. Von Neumann was the guy who, he was a genius in many, many dimensions, including really of developing the modern computer as it is.
Wow. And
modern mathematics and utility theory, the modern justifications utility theory, which I build my work on.
Yes.
And so on. And I say it's 3 times as good because it recognizes 3 things I did. The portfolio theory, sparse matrix research, which is a solving systems of equations which are enormous but have mostly not zeros in them, a few non-zeros, like most big industrial applications have.
Right.
And then a programming language called SimScript, which has been widely used and still around for simulation programming, getting a computer to pretend like it's getting a computer to pretend like it's the inside of a computer or a manufacturing system or an air transport system. Right. So it recognizes these 3 things I did. And as I like to say, hey, I'm not one of your one-shot Nobel laureates that can only do one thing. And I'm very modest.
Yes. You can see that. Well,
I don't
certainly has been.
Wait a minute, I have my lunch. One last before you wind up.
Yeah.
I don't like to seem immodest. I am immodest, but I don't like to seem immodest. And okay, so you can have your closing remarks.
Well, it has certainly been our honor and our pleasure to have you with us today here on IFA TV.
Fantastic.
Thank you, Harry.
Thank you much.
All right.